All right, welcome everybody, and thanks for joining us. We're just a couple minutes from getting started, so thought I'd get the webcam up and running and introduce myself here just briefly. You can see me here. So this is a live presentation, and we'll give another minute or so before we really get started. But I'd like to encourage you to use the functionality on your GoToWebinar tool with the chat functionality and questions. Feel free to ask questions along the way, make comments, give me feedback. That's the only way I know how to react and respond. And I'll try to get through questions during the presentation as we go, but for the most part, I think we'll probably answer a lot of your questions as we go. And then towards the end, we'll have a kind of a Q&A and a FAQ, frequently asked questions section as well. But we will talk about options trading. We're going to use technology and algorithms to really do a lot of the work for us when we're trading options. So we're going to talk about that, a little bit about what's going on in the markets. We'll have a live demonstration of the technology. And this is really based on feedback from clients over the years. This is what we put together based on working with thousands of clients over the years and trading millions and millions of contracts. Okay, looks like a lot of people are still joining us, but we will get started on time. So we're going to talk about how you can easily place option spreads. We're going to use some technology that our group of traders is using. These are pre-built spreads with automation for risk and profit management. We're going to look at hedging strategies as well as directional and non-directional strategies. And then, of course, one-touch trade alerts, which you probably have never seen before. So you're going to love that. And let's jump in with the preliminaries here about speculation. Remember, we're trying to make money. That's the whole idea here. Although some of you may be looking to hedge your portfolio, but either way, there is always risk when you're trying to speculate and make a profit. And do take a look at that risk disclosure. It is important. And if I don't always look like I'm staring at the screen, that's because I have 3 different screens to run the presentation, so I have to look in different places. So it doesn't mean I'm not paying attention or engaging with the with the screen here and the camera. But remember that all funds committed should be risk capital, and past performance is no guarantee of future results. Okay, let's look at trading stock index options. We'll use proprietary automation, and we're going to specify why we're looking at index options and not individual stock options. We'll get to that in just a minute, but here's the idea. You don't want to be this poor trader here struggling. You want to be more like this robot, confident in everything placed and handled for you. A little bit about Altivest. Since 1997, we're a registered introducing brokerage firm, decades of experience, millions and millions of options, contracts, and futures over the years. That's yours truly there in the middle with some of our colleagues and our traders on the floor over the years. We're registered with the CFTC, an NFA member headquartered in California. Those are the 2 entities there that regulate and oversee our industry. We've traded millions of contracts along the way. I think that makes us somewhat of an expert in this space. Maybe you've seen us on Market Watch. Here's an article just a couple weeks ago. You can see here quoting us as well. So we have a lot of experience. We don't want you to figure everything out by yourself. And that's why we're here. Don't be like the guy in the basement. So we're going to show you something, a trading solution built with decades of experience by industry veterans. A little bit about myself. I'm Erik Gebhard. I've been doing this about 30 years now. Back in 1991, I was licensed. I have my BS in business administration from the University of Southern California. So the Trojans out here in Los Angeles. And maybe you've seen some of our presentations over the last couple of years, especially since the lockdowns began. And if not, Hopefully you enjoy the demo you're about to see. I got started back in the securities industry with my Series 6 and 63 licenses, mutual funds. I then, of course, have the commodity futures license as well. Also my Series 65, which is an investment advisor license. So let's look at a couple of things here. Markets are already falling from their peak. I'm sure you're well aware of that. The Russell 2000 and Bitcoin both made the highs in November 8. NASDAQ closed at its high on November 8, had an intraday high on November 19th. Just a graph here of the pullback in the Russell, just on the edge of bear market territory, down 18%. Bitcoin, as you know, making news, making headlines just about every day, down from, what was it, 65, almost 70,000. I can't remember the exact number. NASDAQ down about 11%. Talk about volatility. Facebook down 42% from its high. And in fact, we're going to circle back to not necessarily, remember, we're not looking at individual stocks, but I think the point is I want to make that an individual stock index is not going to drop typically nearly as much as perhaps an individual stock. And that's why we like to look at the index. Now, what about an ETF? Maybe you think you're safer in an ETF. How about this? Microsoft and Apple make up 40% of this enormous ETF. If you don't know what it is, it's the XLK technology ETF. Tesla and Amazon, also 40% of the XLY consumer discretionary ETF. There's enormous ETFs, but there's really no diversification in those types of ETFs. They all kind of hold the same thing. Concentration risk is what they call it. Even hedge funds, the growth hedge funds, are suffering their worst rout in years. So very difficult in the last month. So what happens though if the Fed hikes rates? Wall Street projects 5 to 7 rate hikes in 2022. That's based on analysts and also the Fed funds futures. But don't worry if you don't know what that is. Just know that this is the current expectation. But it says, meanwhile, economic growth is already decelerating. So if the Fed does what the market thinks it will, stock market volatility will expand and remain elevated. And that means stock prices plunge. So if the VIX expands, then stock prices plunge. Here's the probability for the Fed meeting in March next month. 75% probability that the target rate moves up here, and a 25% probability it moves even higher. B of A forecasts 7 rate hikes in 2022 and then pain. So we shall see. But what happens if the Fed hikes? This is a good quote here. Being late to the game is the Fed's MO. They mistimed this one perfectly. Economic growth is beginning to slow stateside. Powell is now in a position to repeat the mistake he made in Q4 of 2018, in which the S&P's total return was negative 4%. So basically they're hiking rates into a slowing economy. And it says here the US consumer is tapped out. The Fed erred last year, allowed inflation to run red hot, but in 2022 it won't spot the economic slowdown in time, and it will keep tightening right into a major recession. So here's a monthly graph on the S&P 500 when the Fed tightened in the past, and perhaps we'll see a repeat of that. So something to keep in mind. And just, well, we're going to run through this quickly, but the economic data is decelerating or plateauing. And, you know, the Fed and Wall Street analysts and headlines are usually backward looking. So look at this, home prices decelerating 4th straight month. Initial jobless unexpectedly surged a 3-month high. Economy slowdowns deepens, economic slowdown deepens. U.S. existing home sales suffer biggest December drop since 2009. Consumer comfort index dropped significantly, lowest since June 2020. The IMF issued a warning for GDP growth, reducing their expectation there. They warn on aggressive tightening. Historic highs in global debt, largest surge in 50 years. Here's a gentleman here says the financial cycle is down, the war cycle is up. And inflation, meanwhile, I'm sure you're all aware, inflation and oil prices. Oil remains elevated. How about this off our local newspaper? Look at the price of gas here, $5.99, $6.29, and $6.49. record prices, all-time high of $4.70 per gallon, just on average. Goldman Sachs sees shortages of everything. It says, you name it and we're out of it. Never seen commodity markets pricing in the shortages they are now. It says, we're out of everything. I don't care if it's oil, gas, coal, copper, aluminum, you name it, and we're out of it. So this means that the CPI and PPI are not likely to moderate soon, keeping pressure on the Fed to raise rates in an economic slowdown. So what we're saying here is the consumer price index, producer price index, that's what the Fed's looking at, and they're trying to stave off inflation, which is what they said was transitory last year, of course, but it's not. So, but those numbers still hot like that, looks like they're going to have to raise rates. U.S. consumer prices soar at fastest in 39 years. Headline CPI, here's shelter, housing. Producer prices surge to record high, services sector, and the costs soar there. So just a little background on the backdrop for the global macro and economic landscape that we're in right now. So let's jump into these 3 common barriers for traders. And I'd appreciate if we go through these 3 and make a note in the comments or chat there and let me know what you think is the one that you struggle with the most. There's less than a 1% success rate with day trading. Is that true or not? Let's take a look here. Here's an article, The Day Trading Pandemic. Charles Schwab here did a study over 6 years. They found that their active traders substantially underperformed a simple low-cost index fund. The traders who were most active had the worst returns. Here's another study out of Taiwan over a 15-year period. Less than 1% of day traders consistently beat the market. 80% lost money, and out of Brazil, 3% of day traders made money. So difficult, folks, to make money day trading. And we're going to talk a little bit more about that in a second. And meanwhile, Wall Street Journal talks about social media driving the markets. Staying popular on social media means really never criticizing a meme stock. Everything's always bullish. You've got people giving advice here. This kid found a glitch in the stock market he wants you to hear about. And this person's making 46 million flipping NFTs. So you have to follow them to find out. And this guy here is 18 using 500 times leverage. And this kid here is flying in his helicopter with his, I don't know, is that a Tesla there? So those are all narrative trades, meme stocks, and just kind of that whole social media pump and dump type of, I guess you'd call it theme, narrative trading, storytelling. So number 2, can you actually beat the market if you're trading? That's the next question. It says here that this economist here, Mark Skousen, I always follow him if I can. Here's a scenario they laid out with a portfolio being managed by monkeys. It turns out the monkey portfolio beat the index by 1.7% per year. So here is really your money manager that you should be looking to hire. And how about your emotions? Number 3, the third hurdle. How do you control your emotions? Remember, markets are always correct. We aren't. It can be expensive convincing the markets that you are right. Great quote there. You don't want to end up like this, still thinking the market was wrong all the way to the grave. So there's a lot of noise in the markets, folks. Lots of chatter, bull, bears, social media, business media, you name it. Puts us on this roller coaster, market emotions. You're optimistic, you're euphoric when you're winning. You start to lose, you raise that white flag, you capitulate, you become despondent, and then you get a little bit of hope and relief and back to optimism. So we want to stay off of that roller coaster. And Motley Fool says, our worst financial enemy is us. They talk about confirmation, anchoring, and recency bias. I think this one image here summarizes it. So how often and how many times have we all felt a little bit like this when things are going great? So with that said, remember, algo trading is dominating the landscape, non-emotional trading, but how much is really dominating, or what percentage of the market is algo trading? Well, Here's a quote: 90% of US equity trading volume, according to JP Morgan, is algo trading or systematic trading, or let's call it machine driven. So robots are outwitting humans on their investment picks. That's no surprise, according to Bloomberg. That's what we call revolutionary trading. And here's a brief little video I took visiting the trading floor at the NYMEX a few years ago. So that's how it used to work. And to some degree, there's still some open outcry in pit trading, but not a whole lot. This is really what's happening now, folks. This is your competition, automation. So how can you easily use algo-driven option spreads in your portfolio for up or sideways and even down markets? So we're going to look at futures index options versus individual stocks. And remember, 3 reasons. We like to do what we're doing for 3 primary reasons. 1, the index is always less volatile. 2, we've got strategies for all directions. You can, and also portfolio hedge, and of course bullish or bearish strategies. Much easier to be bearish with what we do and go short rather than saying it is with securities. And of course, one market. You can just track 1 or 2 indexes and not thousands of different stocks and ETFs. So let's jump into how insurance companies make money. Just a quick example. Of course, you know how they make money. You pay them all those premiums. So that's how they make money. But they're selling risk, managing risk, and they always insure themselves. And they have a consistent, patient business model, and they use probabilities, simply math. That's all they're doing, folks, is number crunching, using statistics and actuarials. Just like a casino, we won't go through this full example, but you bet on that 0 enough times, and the house is going to beat you 5.26% of the time. So that becomes the house edge. That's what the math says, and that's why those casinos have big fancy buildings. That's what we're paying for. And that's called higher probability outcomes. And that's what they call being the house. So Nevada casinos report 9th straight month of 1 billion house winnings. And that's just simple math. That's all it is. There's no, math and marketing to get you there and the math to take your money. So they're on the right side of the trade. That's called being the house. So how can you be the house when trading options? Well, maybe we can, maybe we can't. But certainly let's take a look at higher probability option strategies where you collect premiums by selling options. You need to be consistent and patient and manage that risk. And of course, you will have losers. So how do you manage those losers? Manage reward, of course, just as important. You'll need the proper tools to make this happen. And the first strategy we're going to talk about where we're collecting premium, these are really lots of base hits. We're not swinging for home runs and grand slams. And we're going to look at some non-directional strategies for premium collection. And also we'll look at a bearish strategy if you have a portfolio you'd like to hedge against any volatility. So credit spreads are always insured the way we do it, predetermined risk and reward. And they can even be non-directional. And here's an example. Don't worry about this chart if you don't fully understand it yet. I'll explain it. But essentially, you place a trade. Here's your upper boundary and your lower boundary, and here's where the market is when you place that trade. So you have this wide margin of error here for that market to make a move. But first, let's look at the Greeks. We're going to look at just 2 of them when we talk about options, and it's very, very simple. We don't need to get too in depth here and overcomplicated. Delta is simply the approximate probability of expiring in the money. So for example, if an option has a delta of 0.25, it means there's a 25% chance of expiring in the money and a 75% chance it expires worthless. And remember, delta is always moving with price and time, and it is not the probability of a winning trade. So keep that in mind as well. And theta, here's the other thing we need to look at. That's sensitivity to time. And really, it's a function of time decay, meaning every option has limited life. And you refer to that time as theta. It's a negative number. It equals 1 day of time decay. So if an option's at 10 points and theta is negative 0.05, the next day the premium is 9.95. The next day after that it slips to 9.90, and so on and so forth. So that's how that works, and this is what it looks like on a graph. So as the option approaches 0 time left, the value of that premium is dropping and dropping and dropping. That's theta decay. Here's an example of selling a call spread. We'll look at this real quickly and jump into the demo. This red line here is the call you're selling, and you collect 4.5 points for selling it. Put that in your pocket, but you simultaneously buy this blue line, and that's the 45.70 call, and you pay 2.25. But the net result of this is you collect 2.25 points, $112.50 in this example minus your commission, and that's selling an out-of-the-money call spread. Just that simple, and a put spread is really just the opposite. You're selling this put, buying this put, and you collect a net of $100 in these examples. These are not naked options, so you don't want to trade naked, and everything is covered the way we trade. That means your maximum risk is capped in advance, and so there's also no margin calls and no unlimited risk, and that's a big benefit, folks. No margin calls. If you end up selling naked options, first of all, stop doing it. It's not going to work in the long run. I promise you. I've seen a lot of people try it, and ultimately they always give it all back and more. But also the problem is if you are trading naked options, you end up on margin call a lot. So you don't want to do that, or you have to send good money after bad. Here's an iron Condor spread. It's a combination of the put and call spread we just looked at. So this is what it looks like on a graph. Quite simply, you sell an out-of-the-money call spread here above the market and out-of-the-money put spread below the market. And you collect premium on both sides, and then you're looking for the market to stay within this range between the upper and lower boundary. Now here's another strategy you've never heard of. People refer to it as weird, but they love it, and it's called the Dragonfly, and it's 6 legs, and it looks similar to a Condor with an additional leg on each side. And here's what it looks like, and I'll explain that for you. You sell 4 of these out-of-the-money calls, buy 3 further out and 1 closer to the money, and the net result is you collect premium. And same thing on the puts, you sell 4, you buy 3, and you buy 1. Same structure on the puts. And keep in mind, in this example, this one call that you buy is 50 points closer to the money compared to the ones you sell, and the same with the puts. So this changes the whole dynamic and risk-reward character of this particular trade, because remember, you own this call. For example, if the market starts moving higher and higher, closer towards the 4 that you sold, this one that you bought and own is quite a bit closer to the money, and it will act as a bit of a hedge or additional insurance on that position. So there are unique option strategies for bear markets. Why not just sell half of the Dragonfly and just do the calls only? So here's an example here. You can sell just the call side of a Dragonfly. If you're maybe neutral to bearish on the market, you want the market to sort of chop around or even drop, and that way you get to keep the net premium. And then here's something we call a bear hedge, something we created, and let's take a look at that. You're simply selling an out-of-the-money call spread, for example. So here's the market trading right here, and then you decide to sell this call spread and collect money, and the money that you collect, you actually buy a put spread. So and we'll show you that in the demo here. So here's the question though, Jackie Chan, I believe that's who that is. He looks very confused, but we'll try to straighten him out, and all of us out here, we'll show you in the demo how this all works. You know, how do you choose the market? How do you buy or sell? Which strategy to use? What are the strike prices? What are the expirations? What's the price? What's your timing? How do you manage it? All good questions. And these are all answered with Theta Trader. That's our technology with pre-built option spreads. We have a proprietary algorithm creates Theta trades. And then we have everything automated for you for all market conditions. And then we have the automated RTI, that's the risk thermal indicator, and that will then manage all the strategies and positions for you. So simple, effective option spreads. So we'll go ahead and jump into the demo. And I see some questions coming in already. And let's just keep those off to the side for now. Just 1 second. Yeah, people are asking about buying options as opposed to selling. Yes, we can do that too, and I'll show that in just a moment. But for now, let me jump into the demo. And I think what I'll also do is shut off that webcam because I'm going to be staring at a different screen now. I won't even be able to look even close to the camera. So here we have Theta Trader. This is the dashboard for Theta Trader. And I'll describe here just briefly, this section are the Theta trades. These are algo generated. These are open short positions here in this demo account. Any open long or bought positions would be here. And then this is your account info. This is all pulled directly from your AltaVest trading account. So this is AltaVest technology for us and our clients. And then any current quotes would be right here. So the first thing you'll notice, there are bullish and bearish and non-directional strategies all pre-populated here. And you'll notice the markets being traded, the E-mini S&P 500, NASDAQ 100, and Russell 2000. So that's the focal point for Theta Trader, are those three markets, although we can do some commodity markets too with Theta Trader, such as gold and crude oil. Some clients have positions in those right now. But for the most part, we're going to focus on these right now. We'll look at the E-mini or the ES for the S&P 500. And you'll notice right away, we'll go ahead and start with the neutral because we looked at condors and dragonflies. If you want to look at a condor, you'll click on that and you'll see here the algorithm computer has generated all these trades for us, anywhere from 16 to 66 days till expiration. And you'll see the strike prices are already selected, the puts and the calls, and all the profit potential is already calculated. And then your targeted annualized return at expiration is already calculated. Now keep in mind this number here is really to compare one expiration to another. It's not to say that you should expect these types of returns on an annualized basis. That wouldn't be realistic. It's really to compare one trade to another. We'll look at this here. How about the March end of month Condor? It has 52 days till expiration. We'll go ahead and click on that. And you'll see here the computer has basically built and created the trade for us and structured it for us. Let's walk you through some of these numbers real quickly. We won't go through every detail. A lot of it is intuitive and self-explanatory. So you'll see there's 52 days till expiration. Here's the expiration date, the net premium being collected, the risk for the puts, the calls, the commission, the cash required, the profit potential. Let me focus here for a second. Cash required is $896 and your profit potential maximum at expiration is 104. So your targeted return on cash, just over 11%, targeted annualized return. And here's the question. You're going to use almost $900 to try to make a maximum of 100. And that seems a little bit asymmetric, sort of in an unfavorable way. But remember, these are higher probability outcomes. So look at the put we're selling, 3870 put. If you want to look at what that looks like here, the 3870 put, this is the spread that we're selling on the puts. Here's the spread you're selling on the calls. So you have this very wide margin of error. Actually, it's 1,000 points between the puts and calls with 52 days till expiration. So you'll see the 3870 put has a delta of 9.96, which means there's over a 90% probability that this put would expire out of the money. And the call you're selling, delta 6.55. So you're looking at over 93% probability that the calls you're selling will also expire out of the money. So that's what we're looking for in these higher probability outcomes. You'll see it's pre-populated to a sell. We're selling the Condor, collecting the premium. It always defaults to a quantity of 1. Maybe we'll do something more realistic, such as 4. And you can see here, instead of every time you move the quantity, of course, the cash required goes up or down. But we'll do 4. We'll leave the pricing there at 250, and we'll place that order. And it's all done. Just shows up in your order. If this were real, your order get filled, and that's where you would see it. So just that simple. Now let me show you the Dragonfly and compare that with the Condor. And I'm getting more questions, so keep them coming, folks. Keep more and more questions coming as I glance over. But we can get to those questions in just a second. And let's look at the Dragonfly. We'll do the March in the month Dragonfly. Okay. How about an overhead view of the Dragonfly? Here's what it looks like. Hopefully you can see that okay. But this is the structure of this particular Dragonfly. Remember here, you're selling these 48.70 calls, that's the red line, but you buy one 48.20 call, and that's 50 points closer to the money, and the same structure with the puts. And you'll notice the cash required is higher compared to a Condor. So is the profit potential. Targeted return on cash and your targeted annualized return will always be lower with the Dragonfly, and that's because, remember, you are paying money to buy this call and this put. So you're using some of the money that you take in when you sell the puts and calls, and you're using that to buy some additional insurance. And you'll notice here, the put that you're selling, the delta is also below 10%. So that's over a 90% probability the put expires out of the money. And the same thing with the call. You're looking at 93+% probability that this option here will expire out of the money as well. And we'll go ahead, it's already pre-populated to a sell. Maybe we'll do 2 of these. You'll see the cash required is $9,200. And we'll go ahead and place that order. And there we go, shows up as being sold right below the one we just did 2 minutes ago. Let me squeeze that down, there you go. Now here is a great feature. We have a trade simulator. You can go backwards in time, and you can actually backtest these 6-legged Dragonfly spreads or Condors or 2-legged spreads or anything you want. And you get to that right here under simulator, and I've already loaded some right here just to save some time. Let me squeeze this down so you can see more. Okay, so here on July 6th, there's an Iron Condor, and we'll use this button here. You can play or fast forward 1 day at a time or go backwards in time. You'll see here each day that goes by, you can see the P&L of the trade. The RTI is green. I'll explain what that means, which essentially means do nothing. The trade is good. And of course, every time you place one of these types of trades, it takes some time for theta decay to start to work, and that's what really makes the trade become profitable. So when you start off a little bit red, that's totally normal, but we'll go ahead and play this out. So you can see here that P&L is turning green, profitable, which is fine, but Theta Trader says do nothing yet. It's still green. Okay, then it turns blue, and that's a profit-taking order. So with 12 days till expiration, it would generate automatically a profit-taking order if you want it to, and I'll explain how to do that, but that's the key thing. Whenever it turns blue for profit-taking, the Theta Trader is scanning and monitoring the account, and it will place that order for you to close out that position for you. So you can see here that was August 20th on that Condor. Now here is a Dragonfly. So I want to show you here on, this is the end of month August Condor, and that was placed on July 6th. You can see there, July 6th. So on July 6th, instead of a Condor, what if you placed a Dragonfly? Let's run that through. Look at that. It turned profitable on August 4 with 28 days till expiration. compare that to the Condor. Instead of August 20, you had to wait till August 20 before you took profits on that one. So you can see the Condor and the Dragonfly have different characteristics, and the Dragonfly will sometimes mature more quickly than the Condor. So that's the big advantage there. So you can take your money off the table and go to something else. Here's another Condor from March 4. Let's run through that example. Okay, now it's turning yellow. That means slightly elevated risk, and the trade is now turning a little bit red or negative. You can see why. It's moving very, very close to this upper boundary. Then it turns orange, slightly more elevated risk, but still do nothing. The computer and the algo says stay with it. You can see here it's going back and forth from green to orange to yellow. It's sort of flirting with this upper boundary on that Condor. But still do nothing. And then finally at the end, the trade works out and it's profitable. But you were kind of on the edge of your seat a little bit here for the last few days of this trade with that Condor. Now remember, this is the April end of month. So here's the April end of month Dragonfly for that same expiration. Instead of a Condor, we're doing a Dragonfly. And look at that. It turned profitable with 38 days remaining. So you had a day, an opportunity here to close out that position for a win and move on to your next trade. But meanwhile, compare it to that Condor, it didn't mature enough until the very end. So you can see the different character trait between the Condor and the Dragonfly. We'll run through one more Condor. I kind of forgot what these are going to do, actually. Look, turning yellow, turning orange, slightly elevated risk. Oh, and then you have a loss here. Red means take a loss. So this trade turned out to be a losing trade with 15 days till expiration. It would automatically close that out, and then you would then just have your loss and move on to the next trade. However, how about the Dragonfly for that same expiration? Move it so you can see down here. Look at that. It turned actually profitable with almost a month of time remaining. So instead of the Condor taking a loss, you see here the Dragonfly had multiple days of profitability here and triggered that profit-taking signal for you to close out that position. And again, that's simply because you own this call option here, and it's gaining in value much more quickly. The delta is higher, and theta decay won't impact it as much because, of course, it's 50 points closer to the money, or in this case, 40 points. And again, all these trade structures here, the strike prices that are selected, it's all done by the algorithm. So sometimes it may be 40, 50, 60 point difference. It just depends. Now here is the bear hedge. Remember we talked about briefly other strategies, bullish and bearish, but maybe you have a portfolio, you'd like to hedge your portfolio against a possible market crash. You would do something what we call a bear hedge. We'll go ahead and just select one here. I'm just kind of randomly choosing any of these. And here's what it looks like. So you're selling this out of the money call spread. You take that money and you buy an out of the money put spread. So that's what it looks like. The strikes are already chosen for you. You can, it's pre-populated to buy because you're buying it, and it's a negative because it's a cost. It's something you pay. Sometimes you can do a bear hedge for actually even money or a credit, so it doesn't cost you anything. So we'll do 3 of these. And there you go. You can see the 3 puts and the 3 calls. So with that said, let me jump back to the bear hedge here. And let's just run through a back test here of a simulation. So here's one, just a shorter dated bear hedge. You placed the trade and you had good timing and the market dropped like you expected. So this trade worked out here, profitable P&L. And then here's another one. Same type of thing there as well. So you were able to sell these out of the money call spreads, collect that money, and buy out of the money put spreads. You can see, of course, the trade ends up profitable as the market moves favorably. And of course, they don't all work out. I mean, if you're buying premium, that's a low probability outcome. But if you do a bear hedge or something like that for maybe even money, that's not a bad way to go about it, because really the only thing that can hurt you would be a sharp rally against your position. So you can see now the open positions here for the long options. And of course you can do just standard, call spreads, buy call spreads. You can just buy calls, something more advanced. Sometimes we do butterfly positions, or we mentioned the dragonflies. All right, now let me show you, here is the key thing for making all of this happen. Let me go back to here. Here's how you do it, how easy it is to automate this. You go to your account settings, and you simply check this box here to activate the risk manager and activate the profit directive, and then click save, and that's it. So then Theta Trader and the RTI will automatically monitor all your positions and close them out whenever they hit red for risk or blue for a target for a gain. We also have daily research, something called TradeScope. This is our in-house proprietary research. We look at the technicals and some of the fundamental guidance and the global macro picture going forward. We do that every day. And we also have a narrative, which is called a daily trading summary. So this looks at, what did I just do there? Sorry, folks, I went back to TradeScope. There it is. So this looks at what happened in Asia, in Europe, and the US. Have an economic calendar, what to look for, some support resistance zones, looking ahead here, current quotes, and here we can see we sold Russell call spreads the other day, looking at the VIX here. So that's every day as well. That's in-house proprietary research. Then you have a help file. You have, actually here, let me show you this real quickly. If you want to know about the RTI and all those different colors, you can read all about it here and how it works and all the different definitions. So everything you need, it's very intuitive, is all included within Theta Trader. There are videos. These are all videos on using Theta Trader, educational videos on options. There's a lot of information here, all within Theta Trader. But quite frankly, you see how easy it is. And let me show you at a glance. And I'm going to show you the best feature of all in just 2 minutes. So make sure you see this one. Now here's what you do. If you want to look at your open positions, of course, you can just see right on the dashboard at a glance. You can see everything. Or you can look at everything on one page. So you can see all the open positions here on one page. So it gives a summary up here at the top. There are 12 short positions, 1 bought position, summarizes all your premiums and collected and captured and so on and so forth. And you can see everything at a glance here, all the color coding on the RTI. And if you wanted to look at any one position, maybe you want to take a look at this Dragonfly here, the second one down. I'm hovered over, so I'll click on it. And maybe you're scratching your head thinking, what did the market look like when I placed that trade? Let me go back in time. So you'll just click on that and you can scroll down and you can see this is when you place the trade, and you can see the market moving since you placed the trade. And of course you can see below here, trade went yellow, but then turned green again, and theta decay is working. So anyway, that's how you look at your open positions, and then you have your closed positions right here. And I see more questions coming in, folks. I want to hear and see all questions you've got. So if I'm not getting to them right away, that's because just haven't had a chance to pause yet. But you can see all your closed positions here. You can filter, or you can just look at everything at once. Here's a summary here of all the closed positions, and you can see all of them listed here. Usually it shows, I think you can set it up for showing 10 at a time or 20 at a time or whatever. But maybe you wanted to go back in time and look at this Dragonfly. So you click on it, you can see it's highlighted here in gray, and then you scroll down and it gives you a summary of the entry order used, the exit order that was used, and then a graph of what that trade looked like. So you place the trade here, and the market generally went sideways, which is what you like when you're doing a trade like that. And you can see here the RTI turned blue, sent a profit taking order, and you were filled with 24 days till expiration, and you took your profit and ran. And of course, not every trade is profitable, obviously stating the obvious. And this is just a demo account, folks, so I just use it simply in the way that you just saw me, really randomly picking trades on any random day. Now, with that said, let me jump into the very, very best feature of all. I'm going to switch screens, so bear with me. So yes, we can make it easier. So these are trade alerts, and you can do this in less than a minute. And that is not an exaggeration. One-touch responsive alerts. And what am I talking about? Well, you can see here on the graph, you receive the alert on your phone or device, and if you like it, you touch accept. If you don't like it, you touch reject. So all these alerts are live. They're integrated with your AltaVest trading account. So you touch accept, and the order is placed. Our technology handles the order, and that's all you have to do. If you don't like it, you just touch reject. And here's just a quick video. You'll receive a text message with a link. You'll get a description of the trade. Point out here that it shows your net premium being collected, cash required, and you'll notice here it says sell 5, so the quantity is already pre-sized for your account. So everything is already pre-selected for you. And if you like it, you simply touch accept, and our technology handles the rest. Here's another example on an older phone, but you can see, you can zoom in a little bit better here. So again, shows you the premium collected, cash required, the quantity that you're selling or buying, get a description of the trade. You'll see a little bit lower there. Oh, that was my fault. So you can see the targeted annualized return, days till expiration, current futures price, so on and so forth. But everything is in the alert that you need. And if you like it, you just touch accept. So absolutely, people rely on this. Some people just only use the alerts, and they absolutely love it. So I think it's kind of one of those things where most alerts are just an email, and you have to log into your platform and then copy the email, or it's a text, and you can make mistakes. You can transpose numbers. You can do a buy-sell error, which is the worst you could possibly do. But this is very, very convenient. Everything is integrated with your account. All right, so with that said, here's our special offer, the Investor Expo's offer, easily placing high probability options trades. Theta Trader software, you just saw the demo. Our proprietary algorithm will create those spreads for you, simple, effective trade selection. And the RTI will then automatically manage the trade for you for a win or a loss. It will make that decision for you. So that's called autopilot, being non-emotional. You simply check that box in yellow, and that's how you set that up. You saw the trade simulator. You can have a lot of fun with that. It's very useful. I've never seen six-legged option spreads being able to go backwards in time and back test. If it exists, someone let me know, but I've never seen it. So you have the Theta trades, the RTI, and the trade simulator. That software is valued at almost $3,600. And of course, those one-touch trade alerts, everything is integrated with your AltaVest trading account. So every trade is specific to you, pre-sized for you and your account. The trades are selected, for you based on what's in your account in terms of expirations and strike prices. So everything is customized for you and your account. So all you do is touch accept and your order is then placed. And then of course the RTI will automatically manage the trade for you. So a fantastic alert service. I've never seen anything like it. People totally lean on it and rely on it. $4,400 value on that trade alert functionality. So you have the software, and that includes the alerts. So everything there with Theta Trader, over $8,000 value. And then here's the big kicker here, folks. You have a private coach. So with your Theta Trader membership, this is not just an online only type of thing. We're real people doing real work with real experience. We'll share our screen with you and walk you through what you need to know, answer your questions, kind of have a co-pilot, so to speak. You can develop that relationship with. You can review your trades, go backwards in time, look ahead, whatever it may be. But you have a coach, value of at least $7,500. And I'm going to say that is way undervalued. I know people spend $25,000 for education or more. I know I've talked to people spending $50,000 or more. But we can do what you need to know, offer what you need to know to trade with Theta Trader and use our options technology, and we're licensed and experienced. So remember, just to summarize, Theta Trader with the alerts and the coach valued over $15,500. And then just to get a little corny, remember, we do offer that proprietary research. People lean on that as well, valued almost $3,000. And those online tutorials, of course, that's all part of the software. So value of over $18,500 for your Theta Trader membership. You get everything we talked about. $29.97 is the cost of the membership, but not for you. We used to offer it actually even at $4,000 when we do in-person events. We'd have people go to the back of the room, line up at the table, and sign up and become members. But of course, we're doing this in webinars and live online trainings now, and we're going to make that a huge discount for you. We're going to even do better, 80% off, $597, one payment. And that's not kind of a gimmicky thing. It does expire, it does time out, and we don't do these webinars, all the time. So $597, it's an excellent, excellent value, and that's a lifetime membership, and that's only one payment. And there is the link, and that's my direct phone number. I want you to be sure to write that down. And you can call me. It's live right now, of course, so call me and it'll just be transferred. And that's fine. You can talk to anyone else. You can call right now. And there's the link there, cf.altavest.com/TT. And that's a lifetime one payment. It's not yearly, quarterly, and you have no excuse. 30-day guarantee, folks. 30-day money-back guarantee. Rarely has this happen, but if someone has something happen in their life and they need to go in a different direction and they can't move forward, we'll gladly refund and rebate that membership fee. In fact, that's not our business, really. Our business is working with clients and trading, and really, the membership fee is just a very, very small piece of what we do. So not a problem. We're not going to twist your arm to stay with us if you don't want to be with us. So just let us know. We rebate that. A few FAQs now, and I'm seeing lots more questions come in. And let me see if I'm probably going to, let's see here, get to a lot of the questions in the FAQs, but just a second. Tax efficiency. Here's one thing you got to really, really focus on, folks. Your tax rate can be lower by about 10%, your combined with trading futures and futures options compared to securities, because of the, the legal tax efficiency of the futures markets compared to securities. So let's not go through all the numbers, but if you're trading individual stocks in this example, you get a rate of return of 12.6%. in this same example, you trade futures, your rate of return is 14.64%. You save over $2,000 in taxes in this example, simply because you're trading with futures options. So it's a huge difference. It makes a big difference, the tax efficiency. It's IRS section code 1256, I believe. Is that what that is? That's what applies, because you have the 60-40 treatment of your gains. So 60% of the gains are treated as capital gains, which are taxed at a much lower rate than personal rates. So no more itemizing as well. That's a huge advantage. Everything is simple with just one number at the end of the year for your 1099. IRA accounts, yes, there may be some financial or experience requirements you want to ask us. Even Forbes says here you can combat market volatility investing within alternative assets in a self-directed IRA. So yes, that's exactly right. Self-directed IRAs are available through us as well. Here's a question we get: why are you doing just the E-minis? Well, they're liquid, they're efficient, and they're cost effective, and mini can be huge. So it's kind of an oxymoron, but the S&P mini, the E-mini, the ES, it outtrades all ETFs around the world by 2.5 times in terms of its average daily dollar volume. So I bet you didn't know that. And here's the SPY, the ES versus the SPY. It's almost 10 times greater. So this is where the depth and the volume and the real trading and the real professionals are trading, folks. You want to be in these futures markets and these futures options. CME here says 5 reasons to trade options on the S&P. Volume, liquidity, and access. Superior execution, that's what that really means. So they compare the ES to the SPX options, a cost savings of $4 to $15 per contract. So that's what that's looking at here, is the tight bid offer spread on your transactions. And now here's a key. Here's a real key for execution. When you're trading these E-mini Dragonflies with us, these orders are placed. You saw in the demo how I just placed the order. That's placed as one, they call an object, at one net price. So one object at one net price in one order. If you try to do a Dragonfly with securities, and I will challenge you to do this on any platform, you're not going to be able to do those 6 legs as one object at one price. You have to break up that Dragonfly spread into 2 separate orders, and you have to leg in and out of each trade. I've tried it on different platforms. I've researched it, and maybe it exists, but it's just a function of the way futures work versus securities. Remember, futures are separate from securities. Totally different marketplace, much more efficient and effective. And I'll tell you why in just a second. But the largest market share, so you have densely packed strikes, 100 annual expirations, have granularity and coverage. So here's another thing. If the algorithm needs to find a certain strike price, it's going to find it on the ES. If you're trying to do a Dragonfly on an individual stock, remember, some of these strikes that you're looking at might be more than 2 standard deviations out of the money. Deltas might be lower than 10%. So you're talking about deep out of the money calls and puts. And those strikes probably aren't going to exist on individual securities unless you're looking at maybe the biggest stocks, perhaps just a handful of stocks. And even then, I don't think so. So you can see here you have the calls and puts on this Condor that are being sold. A little bit of time goes by, you sell another set of calls and puts, different strikes. A little more time goes by, another set. So that you want to keep your strikes laddered. That's what they call it, among expiration and strike prices. That's called granularity. Another advantage, of course, with the indexes, just say the ES options, you're looking at just one market, not thousands. Efficient margin use versus stocks, and you have a clear cost structure. It's not opaque and cloudy. And let me show you what I'm talking about. Remember, everything we're doing is a futures option. These are not securities, and there are no hidden costs with these E-mini options. So everything trades at the CME Group, the largest futures exchange in the world, and it trades on their electronic exchange called Globex. And what that means is every order you place is routed and filled through the same electronic marketplace and exchange. That means every order, if you have a 1 lot, or a billionaire doing thousands of trades, you're all trading in the same platform. So there's no special treatment for any orders based on size or anything. Everything is equal. There's no payment for order flow like with stocks. And if you don't know what I'm talking about, quite simply, Robinhood, that's what that means. That's payment for order flow. They say they're commission free, but orders are then executed at prices inferior. And what does that really mean? You place an order with these free brokerage firms, and it's not Robinhood only, it's exclusive. It's just about every big box brokerage now says their commissions are free for trading stocks. It's not free. You're just paying a bigger spread. So they sell your order flow to a third-party market maker like Citadel, and the other third party fills your order. And they pay Robinhood and these other brokerages for that opportunity to get those orders filled. And why are they paying them? Well, because they can fill them and capitalize on the spread. And guess who pays for that? You do. Here's the funny thing. I saved 0.01 from price improvements so that high-speed speculators could profit $1. I thought that was kind of funny. It says here, markets are harmed by this practice. It increases the cost to trade for everyone. Retail is not getting the best possible price. And the SEC is actually coming down on this. They may even rule against this whole process. Order flow, payment for order flow is disguised commissions. If you want a broker to work for you, pay a commission. Robinhood gets fined $65 million. You save a penny to lose a nickel. I think that kind of summarizes what I'm trying to say. And nothing of value is truly ever free. So anyway, I'm just kind of pointing out, yeah, we need to have an ability to trade stocks, but let's just be honest with ourselves. It's not free. That's what I'm trying to point out. And that leads us to the question of our commission rates. Our rates are 5.25 round turn all in. Our rates are very competitive. And here's this is a screenshot I took from a big box brokerage firm just this month. And it says they're at here, right here. You can see $225. And you think, oh, gee, that's a lot less than you, Eric. No, that's per side. And they don't tell you that they add more fees on top, clearing and exchange fees, and it ends up being higher than what we charge. So our rates are very competitive. And also point out that everything in Theta Trader is net of all trading costs. So people ask about performance. Well, everyone has different performance because they all make their own different trading decisions. This is self-directed traders, just like you would be trading with any other type of brokerage firm. And again, everything is net of all trading costs. And then what size of account should you use? Well, we suggest anywhere from 25 to 50,000 really is a minimum, because you want to have different spreads at different strikes and different expirations, kind of laddered. And if you do 50,000 or more, we'll rebate that membership fee. People love to take us up on that offer, so we're glad to do that. So yeah, we have accounts, a lot of accounts in various ranges. You get into 6 figures, 7 figures, but I'd say 25 to 50,000 is really kind of the minimum. And we can do IRAs. I mentioned that, individual, joint, corporate, LSE trust. Individual or joint account can be turned around sometimes in a day, but these other accounts will take longer, especially the IRA. Now, just kind of summarize here and wrap it up, and we'll get to some questions. Why would you even want to do this in your portfolio? Or why would you want to add this to your portfolio, this type of trading? Well, this is really called an alternative asset class or alternative approach with a low correlation to traditional investments. So any one of these strategies we looked at in the simulator really don't rely on the market, say, moving up all the time to do well. The market could go sideways, it can go down sometimes, it can go down a little bit, it can go up a little bit. And, for example, you can do a bear hedge or some bearish strategies, and market drops like a rock, and money managers are taking a beating, and meanwhile, you're not, because you're hedged. So it just helps improve diversification and lowers portfolio risk. And there's, Fed-fueled asset price inflation going on. You got to keep that in mind. You're losing money if you're not making more than inflation. This is kind of a crazy chart. You see the S&P is red, and so their blue line is the assets of the major central banks. So huge correlation there between money supply and money flowing into the stock market. Here's the CRB index, commodity index, continues to ramp up. And that really is just taking money out of your pocket. So that's inflation for you. Why alternatives? Well, what about the 10-year stock market returns? Let's forwardcast here. This is kind of interesting. The next 10 years don't look good. Americans have a high allocation to equities, and that is a contrarian indicator, suggesting weak returns ahead. There's a statistic known as R squared, and it's an indicator since 1951 has been able to predict 70% of the changes in the stock market's 10-year return. So what does it say about the next 10 years? Projecting the S&P will produce a total real return of minus 4.2% annualized in the next 10 years. So that should give us pause and give us food for thought. You know, we're not really liable to continue to make these enormous gains year after year in the stock market. Everything will mean revert at some point. And it's just like I said, unrealistic to expect it. But here's the thing. Average US retail investor does expect a 17.5% annualized forward return. That's amazing. So the expectations are huge right now. And I do have some time. Let me just make a comment here. In December of '99, the average retail investor expected a 19% annual return on equities. And what were the next 10 years like? Negative 2.3% compounded annualized growth return. So we've seen this story before. So here, investors expect this 17.5% return, but realistically, advisors say more like 6.7%. And that would be above inflation. So a lot of work there, folks. So we like the low correlation that alternatives offer, such as what we're talking about. Having an allocation in that alternative investment space makes a lot of sense. You don't want to just be passively long an index or trying to stock pick. And that, you know, that may work at times, but you don't want to only do that, is really my point. You don't want this, you don't want that. You want something like this where you have an allocation towards alternatives, and we'd like to be that piece of the pie for you. So that Theta Trader membership, remember, you have all those pre-selected spread trades, automated trade management with RTI, those integrated one-touch trade alerts, you have personal coaching. I think that's kind of the key element here, the differentiator, the defining element, really. We're not just a chatbot, online only type of thing. And it's process driven, use automation and algos, you have strategies for various conditions. It's not a one-trick pony. And there you have it, folks. That's our lifetime membership. It's one payment. It's only $5.97. And we get you started and get you onboarded. There's our link. There's our phone number. You can email us. Let me see here if there are some pictures. Not pictures, I'm sorry. More questions. I didn't get a chance to get to it. I do see a lot of questions. Okay, people are asking about, yes, there will be a replay, and the pricing for the offer I just mentioned is right here, cf.altivest.com/TT. So that's where you go to get the pricing. Someone's asking, where do the orders fill? Well, they're all filled with, like I mentioned, through Globex, just through the exchange there at the CME group. Yeah, the cash required is a euphemism for margin. So yes, that's the same thing. And someone's asking about debit spreads. So it's just the opposite, of course, of a credit spread. So if you buy a spread, that's a debit spread, and you're paying money for it. And the person who sold it to you essentially is collecting that premium, and it becomes a credit spread to them. All right. Let's see if there's any other questions here. Someone was asking about, I don't see, yeah, the cost, it's just a one-time membership fee to use our technology and to become a member and to trade with us and have our coaching, just $5.97. There's no monthly cost to Theta Trader or for the alerts or anything like that. Okay. Yeah, you don't have to lease anything. And yes, there is the link. It's been posted for you, cf.altivest.com/TT, or it'll be a TT Elite, either way, but just go TT at the end, ends up in the same place. And yes, you can do this with an IRA. That's correct. You do IRA accounts, and there's no yearly maintenance fee. And you open your account with us like you do with any other brokerage firm, and most people will deposit funds into their account with an ACH transfer, or you can do, of course, a bank wire. Yes, 1099s, of course, are provided, and you just use the, excuse me, the data on the 1099 and just fill out the field as you update your tax software. And everything is through your AltaVest account. That's correct. This is our technology that we created. And someone's asking about, can only calls, puts be bought and sold? It's only for options. That's correct. So Theta Trader is an options trading platform. We do trade futures as well. That's a separate software platform that we didn't talk about. We have some automated futures trading systems available, and of course you can also just buy and sell futures systems. Futures contracts if you'd like as well, because we can trade everything. But we did focus and specify here Theta Trader for today. Only had so much time. And let's see, yeah, everyone has different performance. It's just like, if Susie places some trades that Jack doesn't, then everyone's going to have different performance. And yeah, the commissions were listed here in the presentation. Account size, we suggest 50,000, and you get that rebate as well. Okay. And yeah, people always ask, and I'm sorry, but we cannot accept Canadian accounts. I would love to, but you need to have a valid, legal U.S. residence if you're from Canada to be able to have an account with us. We can accept UK, Australia. The EU is difficult, so all the politicians make it very difficult. Okay, and people ask about, yeah, you have an account with AltaVest. Your trading account, we are the brokerage firm, and this is our technology. So to use it, you have to have an account with AltaVest. That's correct. And the $597 offer, it expires on the weekend. And I did that so that you have some time between now and then to call me or to email Erik, E-R-I-K, at altavest.com. That's my direct email, or you can use info, but that'll go to someone. But give me a call if you have any questions. But quite frankly, it's pretty simple. If you'd like to get started, you use that form, one page there, you just fill it out, submit it, your $597 one-time payment. And if for some reason you change your mind in the next 30 days, we just rebate that. So it's just that simple. And what else is there? Yeah, the offer is good through this weekend, and we suggest 25,000 as a minimum. If you've never ever traded options, you probably want to go through the help file and look at all the tutorials. That would be very helpful. And yeah, that's correct. You do have to have an AltaVest trading account. And let's see here. Yeah, everyone has different performance. Everyone's asking that same question. Yeah, the webinar is recorded. If you do not respond to a trade alert, yeah, I'm getting, is that Timothy asking? Correct. If you don't respond to the trade alert, then nothing happens. Correct. And yeah, you would be making your own trading decisions in terms of deciding on which alerts to accept, or at which time of day you might accept them, or using the platform itself and selecting certain trades at certain prices. So all of that, you're making those decisions. Of course, we can help you. Yeah, I wish we could do it with Canadians. Another account there we have to turn away. I'm sorry, we can't. And let's see here. Yeah, 50,000 will get you that rebate for the membership fee. And if you have less than 25,000, feel free to call me and talk about it with me. And the part of the reason why is each Dragonfly is 5,000. required. So if you had less than 25,000, you're going to be limited. You might even, you might not be able to do a whole lot and kind of have a concentration risk on just one particular position. And let's see here. Yeah, you can sign up as a member, and if you wanted your spouse to trade with you, that's fine. You don't have to have 2 different membership fees. We do that all the time. And the replay will be sent to you. That's correct. A typical trade, that's a good question. Well, here, let me show you here. Someone's asking how long does a typical trade last? And yes, simple options trades can be done as well. And let me do this real quickly. Thanks for sticking with me, folks. If you're willing to stick around and ask questions, I'm willing to sit here. So let me just do one more thing. If I can switch my screen again. Okay, someone's asking how long does the typical trade last? But you can see here the Condors for today on the Theta trade section. Let me expand this. The computer has selected anywhere from 16 days till expiration to 66 days till expiration, and that's pretty typical. You might get as much as 70 days sometimes, and maybe maybe 20. So, but anywhere in this range on any given day are the days till expiration. And in terms of how long a typical trade might last, keep in mind every trade will be closed out before expiration. So you saw like in the simulator where, in this case here, this trade was a loser. It had 15 days till expiration, but then the Dragonfly was able to get closed out here, and it had still 22 days remaining until expiration. So when you placed it, it had 73 days, and then when you closed it out, it had 22 days. So it just depends. And of course, a bear hedge, you could do a shorter dated bear hedge. Here's one we placed in November 22, and it ended on November 30. So it really just depends. That would be something like, let's see if there's, yeah, so here's one here. Here's a bear hedge for 9 days. So maybe you're thinking there's a short-term drop in the market up around the corner. You might want to do something like this instead of having a position that has many more days on it. So the answer is the days till expiration are quite flexible, just depending on the strategy, but hopefully that answers the question. And then, oh yeah, someone else asked about, can you do just simple trades? Yeah, absolutely. Here, you can just buy some calls. You can just buy calls. Maybe you just want to buy puts. Is that simple? Or maybe you want to just buy a put spread. So here's a March end of month, and you want to buy a put spread. Do you think the market's really going to fall out of bed here? So here's the March end of month put spread, has 52 days till expiration. Here we are right now, and here's the put spread that you're buying. So absolutely. And of course, you can change this too. You can adjust the strikes. You can change it if you'd like. The algorithm will kind of tell you if, for example, if you did a Condor, here's a February end of month Condor. And here's what it looks like here. Here are the strikes the algo has chosen. You can change the strikes, but it's going to kind of upset the apple cart, so to speak. See, it changes all the dynamics. So you can change it and modify it. Certainly you can do that. All right. I think those are some good questions. Simple trading, yep. How does crazy volatility? Yep, that's a good question. Well, of course, if you, it depends on which trade you're talking about. The volatility will always affect a trade. It just depends on what your position is. If you are in a particular position like a bear hedge, and the volatility increases, then you're going to be doing well. If you're in a Dragonfly, for example, then the answer is it depends on the magnitude of that volatility. So, Dragonfly, for example, is a very robust position, but there are times where it will come under pressure. I think anecdotally last year, out of all the alerts, I think we had one, maybe two Dragonflies that had to get closed out for a loss. So that was a pretty good year. But if you go from 20 to 50 in a week on the VIX, then any short option strategy that short puts is going to have trouble, and you're going to end up taking a loss and moving on to something else. But that's why we like also the bear hedge strategy as well. So, okay. Can you use own discretion to close out a transaction prior to the program? Well, yeah, you can simply, in your settings here, if you want to make your own decisions, you just deactivate the risk manager prior to placing a trade, and then it won't track it. If you have this selected and you're in the middle of a trade and you want to get out before the risk manager or profit directive takes effect, then yeah, you certainly just let us know and we can do that for you. Okay. Yeah, very good questions, folks. I look forward to hearing from you and having looks like quite a few of you are interested in coming on board. So look forward to it, and that's why I like doing these webinars. So we get to reach out and have a whole new set of eyes and ears on what we're doing, and we're getting a lot of great feedback, especially last year, even the year before. People are looking for something unusual, something out of the box, and you can't just rely on social media for your stock tips. It doesn't work like that. It's not that easy. Okay, and a few more questions. Dragonflies you would not roll, and yeah, talk to us if you have some questions about how much money you wanted to start trading with. And we do offer, talk to me again if you wanted to get a peek beforehand, sort of as a demo. So do talk to me about that. And the e-micros don't really work as well for what we're doing. The value is just so small that it's just not there yet. Maybe over time it will be, but the e-minis are really where you want to be right now for this type of trading. That's where really that depth and the liquidity resides. But you've got my number there, 236-6961. Give us a ring, Erik, E-R-I-K, @altivest.com. Or quite frankly, you can go right to the form, cf.altivest.com/TT, and that will get you right to the sign up page. And be glad to have you sign up and get you up and running and onboarded. So with that said, I think I'll let everyone get back to work, and I'll have to do the same. And I've kept you here long enough. So thank you everyone for joining me, and have a great day. And we'll talk to you soon. Look forward to hearing from you. Bye-bye.